What I'm going to try to do, or what Torben's going to try to do, what we're going to try to do is kind of make sense of a lot of the things we talked about in each of our talks this morning, or afternoon for Torben's case. I talked about these realized volatilities, and Torben talked about these options implied volatilities. So what I want to do is sort of in this last lecture is think sort of more. Torben already started a lot of that, but I want to think more about sort of how do these volatility measures relate, and why do they relate in the way they do, and what kind of information is there potentially in the difference between these volatility measures. And I think as it turns out that there's a lot of useful information, and still sort of as of unexplored useful information, and I think we can learn a lot. I mean, I think this is kind of really like a ripe research area, trying to sort of build on these linkages. So what I'm going to do first off is, as I said, sort of talk a little bit about these things and how they relate to notions of risk premia, risk aversion, and then I want to also then highlight what I think are some like rather striking returns now, predictability results that come out of looking at the information in the wedge between these different volatilities. And I want to think about from more of an economic perspective why it is that these volatility differs, and think about sort of where does that sort of difference or that premium that Torben was talking about come from. And Torben's going to talk a lot more about that and really sort of decompose or dissect that variance risk premium more in terms of think about where's that really lying in the whole span of different options or return distributions. So let's get going here. So again, this is going to be basically kind of, I'm repeating here a lot of what Torben already said. That when you're trading options, you're in essence trading volatility. I think made that same point this morning. Okay, Torben already put this formula up on his transparencies, which says that you can in fact use sort of the Black-Scholes or Black-Scholes-Merton option pricing formula that in essence assumes that prices follow this geometric Brownian motion, constant drift, constant diffusion. You can allow these to, as Torben also said, you can allow these to be deterministic functions of time, and the same thing would kind of go through. The Black-Scholes implied volatility then is the volatility that makes the Black-Scholes price equal to the actual price of the option with a particular characteristic you're looking at equal. Okay. The actual market price, that is, of that option. Okay, and we can view this in many ways as some kind of market-based forecast of what is the volatility of the option over the maturity time of the market, of the underlying asset on which the option is written, over the maturity time of the option. So as Torben showed us, I mean, when you do this, and if you look at these implied volatilities using the Black-Scholes model as a way to look at that, you find that these implied volatilities varies across strike, and they vary across expensiveness and moneyness of the options. So here's a picture of that I took of one of Hertley's papers, which shows exactly these kind of smile or smirks for different maturities and different moneyness. Okay. So as Torben said, that a lot of work have gone into, and that's what the paper by Wolfgang is about, trying to sort of approximate in various ways these implied volatility surfaces. And there's a lot of good work in terms of doing that. Related to that, and again related to what Torben talked about, the fact, of course, that these implied volatilities are not constant, that this isn't a plane, they vary with maturity, or in particular they vary with moneyness, implies that the Black-Scholes assumption, the constant volatility assumption, is not true. Okay. So another way of sort of attacking that problem, I think Torben referred to this as kind of like the parametric modeling approach, would be to say, look, can we write down a better parametric model and think about what would the option pricing, or what would the option prices look like in a more richly parameterized model that allows the volatility to be constant, and possibly also allows, as I mentioned this morning, for the idea that there might be jumps in the prices. And can we, by having these kind of richer underlying structures for the underlying dynamics, can we then potentially kind of reproduce these implied volatility surfaces, and can we also potentially estimate them better and so forth. So there's a lot of work that have gone on doing that. I'm not going to go into any detail of that, like Torben really didn't spend a whole lot of time doing that either. Okay. Another relationship, another thing that where there's been a lot of work, goes directly to what Torben talked about in the last bit of his lecture right before the coffee break, namely the question of how good a forecast are the options implied volatilities actually of the volatilities that subsequently get realized. So if I run these regressions that Torben were running, where I put the realized volatility on the left-hand side of the regression and regress that on different volatility measures, different implied volatility measures backed out from options. This could be Black-Scholes, this could be the VIX, the model free that I'm going to talk about in just a second, that Torben also highlighted, or it could be one of these sort of corridor variance contracts that Torben introduced us to. But the early literature anyway was typically run, or typically sort of conducted inference in which we would take things that were like Black-Scholes implied volatilities as what the market purported, sort of the expectations of the volatility over the maturity time of the option to be, and asked, is that a good forecast of the volatility that subsequently get realized? Okay. Now these regressions, or this kind of way of conducting that inference is plagued by all sorts of problems. Again, Torben alluded to some of these. There are errors in variables both on the left-hand side and the right-hand side. There are issues having to do with sort of strong persistency in these regressors. I think Torben showed us some autocorrelations, and these were very, very high. Arguably, these are sort of fractionally integrated processes, and there are sort of special issues that come up vis-a-vis inference in those situations. There's also issues having to do with the fact that if you run this using overlapping data, so you have like an option that lives for a month, but you run this at a daily basis, the errors here are going to be serially correlated, and you have to somehow adjust for that, and that creates various kind of issues too. Anyway, sort of the old literature, one of the things that sort of came out of that people have sort of written lots of papers about is that when you run these kind of regressions using Black-Scholes implied volatilities, you typically find, and it turns out not really surprisingly, but some people have sort of written as if it is surprising, that in that regression, the beta coefficient is typically less than 1. And moreover, the intercept is oftentimes also positive. But in particular, the beta coefficient, or B1 coefficient, sorry, is typically greater or less than 1. Okay. So there's nothing wrong with that, but a lot of people, as I said, have sort of speculated that is kind of anomalous, or sort of argue that it might be anomalous. So what I instead want to think about in this context is, what might we actually reasonably expect the B1 coefficient to be? Is it anomalous to find the B1 coefficient to be less than 1, which I'm going to argue it's not? And in turn, what can that relationship, as implied by the relevant B1 coefficient, in effect teach us about sort of the way the market prices risks, or risk premia more generally? Okay. So I'm going to start out, think about that issue by just sort of postulating a very simple parametric model for the underlying asset. Okay, this is one of sort of the simplest, somewhat reasonably stochastic volatility models out there, sometimes called a Heston stochastic volatility models. It looks like this. So it postulates that the volatility follows this affine process, the instantaneous volatility. Okay. Now to price the option, as Torben kind of explained to us, we have to think about it. We can effectively price the options as the discounted payoff, but not the discounted payoff in this distribution, but in the risk-neutral distribution. Okay. Suppose that volatility actually did carry a risk premium, and a reasonable way of thinking about that, suppose for the sake of argument now that it carried a constant volatility risk premium, let's just call that lambda. Okay? What does this very, very simple stylized model setup imply you would get, or should get, in the kind of implied realized volatility type regressions that Torben was looking at? And Torben wasn't making any conclusions as to what the B coefficient should be, anything like that, but a lot of people have done that. What would this particular simple model imply you should get? Well, if you look at the corresponding relationships, think about the integrated volatility as, in effect, sort of being what the true realized volatility is. This is the options implied volatility, that's the expected value of that thing in the risk-neutral distribution. Okay, you can go through and fairly sort of easily show that in this model setup, under that assumption about the way volatility risk might be priced, that the B1 coefficient in fact should be less than 1 if volatility carries a negative risk premium, which has a lot of empirical evidence to suggest that it does. So from that perspective, the finding in many of these regressions of the B1 coefficient being less than 1 is by no means anomalous. Okay. Now, this in of itself then, that relationship here also suggests that I could sort of go one step further and in fact think about now looking at this relationship using a measure of the integrated volatility and a measure of the options implied volatility to learn something about the way in fact the market prices volatility risk. So I could do this in this kind of parametric fashion, if you will, by thinking about taking the integrated volatility on the left-hand side of that regression, which of course I may estimate sort of very well by using the realized volatility measures that I talked about this morning. I could run a regression in which I regress that on these options implied volatility measures. Okay. Now I could stick in sort of the Black-Scholes option implied volatility in place there, but that would be really kind of more inconsistent with the arguments I've made so far, because I said, look, let's assume that we have this particular model structure where volatility explicitly is time varying, which of course is counter to Black-Scholes. So I need a measure of the volatility implied by the options market that is consistent with this particular model structure. Well, what I can use is I can use these model-free measures that Torben talked about that in fact are consistent with any parametric model structure, they're being model-free. Okay, and I can use that to, in this particular completely model-free fashion, actually estimate this option implied volatility. Okay, so this is basically just a transparency that kind of says that and sort of reiterates some of the main points or main arguments that sort of underlie that measure that Torben also alluded to, that in some sense a lot of this derives back to the fact that you can think about the sort of second derivative of the call or the put with respect to the strike as basically giving you the risk neutral density at that particular point, the call, and then by correctly averaging, as Torben sort of laid out, or integrating over those, as Torben laid out how to do it, you can actually get an estimate of the option implied risk neutral expectation as written there. Okay. Now, this is what the VIX index, the index for the S&P 500 sort of pretends to do. Now, there are problems having to do with the way they extrapolate in the tail, and Torben sort of highlighted that very much in his sort of discussion before the coffee break, and I think he's going to talk more about that in a little while. But for now, what I'm going to do is I'm just going to take the VIX kind of at face value and treat it as if this is in fact this risk neutral expectation. So just like the realized variance that I would use to estimate my sort of true integrated volatility, in fact, is going to be estimated with some error if I use, say, 5-minute data, which is what I'm going to be using. My VIX measure, as constructed by the exchange, is not exactly going to be sort of a truly model-free measure for that, but it's good enough, it's close enough, and I want to look at that relationship. Okay? So just again, this is a picture that kind of you saw earlier on. This is a picture of these time series. Okay, so the top picture, these are in annualized standard deviation form. The top picture is the realized volatility for the S&P 500 over this historical period, constructed using 5-minute returns. This is monthly realized volatilities. This is the corresponding options implied expectations as given by the VIX index. And if you look at the difference between the two, so you take the blue line, the middle line, minus the top line, you see this generally on average, a few exceptions, but on average, this difference is clearly positive. There's a volatility risk premium. I defined it in this way to be positive. People oftentimes define it the other way. I've defined it here as being the VIX minus the realized volatility. Some people define it the other way. I can debate whether one way is better than the other. I think there are reasons to defend both. But this is just illustrating that the blue line minus the red line is on average positive. Okay? So what I'm going to do now is I'm going to say, look, let me take those two time series, the top line, the red line, and the blue line, and stick the blue line in there, stick the red line in there, and run that regression. Okay? And by running that regression, I can then, of course, estimate the B1 coefficient. But more importantly, if I'm sort of willing to say, look, I'm going to assume this very highly parameterized, stylized kind of Heston stochastic volatility model, it then also allows me to bag out what the volatility risk premium is implicit in the relationship between those two time series. Okay? Now when you do that, you're going to find that the volatility risk premium is negative, and it's very statistically significantly negative. Okay? I'm not going to show you that estimate. Instead, what I actually want to do, what I think is kind of intriguing, is I want to go one step further. I want to say, look, maybe volatility risk or the volatility risk premium also varies over time. Okay? This thing clearly, the difference, the raw difference, clearly shows some distinct and apparently predictable dependencies. What about the volatility risk premium itself? So this is based upon a paper with Hao Su and Mike Gibson where we did something, it's a completely ad hoc approach, and I'm going to get to something that's not quite as ad hoc in a second. Well, we said, look, let's just suppose, or let's just parameterize this volatility risk premium as a function of its own lag and various other sort of macroeconomic type state variables. And then let's sort of put that parameterization into that relationship, and let's see what is the relationship between the realized volatility and the options implied volatility imply vis-a-vis the temporal variation we see in this volatility risk premium. And we've got this picture which I kind of like, and which is why I'm showing it here, obviously, which shows the sort of estimated volatility risk premium implied by doing that sort of ad hoc thing. The thing I like about it is that if you look at the volatility risk premium, it's clearly time varying. Okay, there's no ifs and buts about that. Okay, I could put standard errors on that and you would clearly be able to sort of reject the hypothesis that this is constant through time. But what you also see is you see sort of tendencies for the volatility risk premium, the market's sort of premium that it puts implicitly in the way it prices the S&P 500 options, that it clearly goes up in periods of sort of market distress. Okay, so I've indicated here a number of sort of well-defined, and I think we sort of all agree, are sort of periods of market distress. So the volatility risk premium is clearly high in periods of financial crisis or bad times. Okay, it's also high in periods of high volatility or volatility. Something I'm going to get back to later. Okay. Now, the volatility risk premium, I'm not going to lay that out, but there are various references here. There are other papers out there that have made that same observation. The volatility risk premium, sort of made that observation verbally, I guess, may be linked also to notions of aggregate risk aversion in the market. Okay? It in effect reflects the way the market prices risk, and you can write down various representative type models that in fact would make that sort of a link, sort of a monotone one-to-one. Okay? And that's done in one of these papers, particularly this paper by Gordon, Sandamu, and JBS that makes that observation very nicely. So what that suggests is that if the volatility risk premium is changing over time, in turn the risk aversion in the aggregate market is changing over time, that should have implications for return predictability. If risk aversions is changing all over the place, that should mean that I should be able to utilize that in coming up with return predictions, because investors are going to require different compensations for taking on different risks. So there should be notions of return predictability implied by this. Let me just show you sort of one first sort of striking picture that I think sort of clearly suggests that there's something to that effect. So this picture here shows not actually the volatility risk premium that we estimated. It shows something that's even more simple than that. Okay, it just simply shows the options implied volatility, the VIX. Again, I should be careful here. I mean, Torben pointed it out, and I'm not very careful usually in this. This is really kind of what you would refer to as the VIX squared. This is the variance. Okay. So when people talk about the VIX, they typically talk about it in volatility form. Okay, so I'm looking at the difference between the options implied variation of volatility. Torben was much better in terms of actually explicitly differentiating between when you look at volatility and variances, and it is important here. Okay, so this is the difference between the variance, options implied variance, and the subsequent and the realized variance. Okay, that's what I plotted here. Okay, that's the blue line. Okay. And then I plotted along with that the excess return on the S&P 500. That's the red line. Okay. Now when you look at those two, I should point out it's the excess return on the market lagged by a quarter. These are plotted quarterly. Okay. Now when you look at those two lines there, it's a rather striking coherence. Okay. Which, of course, is sort of entirely consistent with this notion that the volatility risk premium has embedded within it. This is not exactly the volatility risk premium, but it's a close cousin to that. It's clearly related to that. Okay, that when the volatility risk premium is changing, there's sort of the compensation that the market is requiring for taking on systematic risk is also changing, which in turn has implications for the price level and therefore the returns. Okay. So there's this kind of striking coherence. Now at this point, this picture is nothing but that, and that's what sort of that the former paper I mentioned is kind of all about. It's just making that observation. But what we've also done subsequent to that, though, is in this other paper, is we've kind of taken that observation, if you will, kind of one step further, and asked the question: what do you actually get if you look at this picture here, and you sort of take it to heart and you actually sort of implement standard return predictability regressions. Can this variance difference actually predict subsequent future returns? Okay? So I'm going to show you the results of those simple regressions for different return horizons. This first table is what you get if you regress the monthly S&P returns on a slew of standard predictor variables down in this part of the table. So things like the price-earnings ratios, price-dividend ratios, default spread, and so forth. Okay, these are all kind of standard predictor variables that have been used all over in the sort of traditional finance literature. When you look at those R-squared at the monthly level, I mean, they're really nothing much to write home about. Not surprisingly, you can't really predict returns at the monthly level. A few of them have sort of t-statistics that are sort of at best sort of marginally significant. And if you look then in the top part of the table, these are similar regressions having to do with regressing on the variance premium and the option implied variance in isolation and the realized variance in isolation. Really none of these sort of coefficients are sort of that significant, or the R-squares are not that big. The picture, however, I showed you before was at the quarterly horizon. And if you run this same regression now with quarterly returns, and it's run at a quarterly return horizon, but using overlapping monthly data to sort of utilize all of the data we really have, what you see is you see quite a striking R-square here. That you see at the quarterly horizon, you get an R-square of close to 7%, which is huge. I mean, you're going to be hard-pressed to find sort of R-squares for any other predictor variables at the quarterly level that is sort of close to that. Now you get one here, I should preface that a little bit. You get one here, if you look at the price-earnings ratios, I should say that has an R-square of 6.5%, which arguably, of course, is close. But the difference, and that is an important difference, that if you adjust that R-square for the fact that the price-earnings ratio is a highly serially correlated process, and these are overlapping overlapping quarterly horizons. The table doesn't report that adjusted R-square, it's discussed in the paper, that adjusted R-square for this highly persistent price-earnings ratio drops by quite a bit. That same phenomenon is not true for the variance difference, because even though the variance difference is a positively serially correlated process, it's not nearly as persistent as some of these other traditional predictor variables like the price-earnings, price-dividend ratios, and so forth, that all have first-order autocorrelation sort of in excess of, as I say here, 0.96. The variance difference has a first-order autocorrelation of close to a half. Okay, so people sometimes call this kind of bias that you get when you use sort of these highly persistent predictor variables, refer to that as a Stambaugh bias. I guess Rob Stambaugh was kind of one of the first to sort of really seriously address the issues and come up with adjustments for that. That importantly doesn't apply here, and still we get this sort of remarkably high R-square of 7%. Okay? If you start combining the variance difference with some of these other predictor variables, in particular the price-earnings ratios, you can push the R-square even close to 17%, which suggests that the variance difference is probably picking up a different source of risk, and I'm going to get to that in just a second. Really a quite different source of risk as opposed to what some of these more traditional predictor variables are getting at. In fact, the increase in the R-square is more than just the addition or the sum of the two R-squares. Okay. So this was quarterly, which is where I get these kind of quite striking R-squares. If I go to annual return horizons, the R-squares for the variance difference drops off, and I get an R-square of like 1.2%. And some of these other more persistent predictor variables now come in, but again, these should be interpreted sort of with a lot of caution because of the huge overlap in the data. Okay? I should say we invariably have a very short sample by sort of return predictability sort of standards of only 25 years due to these, only 15 years, sorry, due to these sort of the available sort of high frequency data, availability of high frequency data and reliable options. So that of course sort of makes the inference a little bit sort of fragile. But I think it is nonetheless this kind of striking. And I think it does suggest that this variance difference does have embedded within it something that is sort of potentially very valuable, and I'll get to that a little more in a second. Okay. Before I do so that, before I get to that and sort of interpretation of those results, let me also just show you a couple of kind of robustness checks. So one of the things we also did was we also ran the regression in which we regressed the returns at the monthly, the quarterly, and annual horizons on the variance difference and just the realized variance. Or you can think about in effect sort of regressing it on the realized variance and the option implied variance in isolation. Okay, that's the same thing. You can of course span that same thing. And the interesting thing here is that if you include both the realized variance and the option implied variance in the same regression, the data tells you that it wants a coefficient of 1 minus 1 on those. it wants exactly the opposite coefficients. Or put differently, if you include the realized variance together with the variance difference, the realized variance is insignificant. So this, of course, is consistent with this huge literature that have been searching for sort of a risk variant or sort of return variance trade-off, and largely in vain, I should say, have searched for that. That is, people haven't really found much when they regressed returns on variance measures, be that realized variance measures on various Scarts type models or the like, okay? Which of course is entirely consistent here. What this suggests though is that wedge between the options implied and the realized variance really is getting at something completely different. And that there's a lot of information that also has return predictability consequences in that. Another thing I should say is that all of these results, I don't have a table to show that, but you can look at that in the paper. All of these results kind of hinges critically for once on using realized variation measures constructed using high frequency data. If you went out and you constructed realized monthly volatilities based upon summing squared daily returns over the months, most of these results would go away. They would simply drown in noise. Because the estimate of the realized monthly variation based upon summing 21 daily squared returns is just too noisy. So again, this kind of highlights the thing I was trying to sort of make an important point earlier this morning, that it's important to get accurate realized variation measures, and the high frequency data allows us a way to do that. Another thing that's also the case is that it's important to use the VIX with all its deficiencies and whatnot, as opposed to sort of more traditional Black-Scholes implied volatilities. If you run these same regressions using Black-Scholes implied volatilities, you pretty much don't find anything. Which goes to some of the things that Torben already talked about, he's going to talk more about, having to do with the fact that I think this difference between the options implied as measured by the VIX and the realized really is something that has to do with what happens in the tails. It's something that sits sort of very far out for these sort of options that are very far out of the money. Okay, it's kind of tail event that drives these things and the way the market prices tail events. It's not something that's sort of happening in these kind of very narrow corridors. If you were to use these, or in these same regressions, the very narrow sort of corridor variance type measures, or equivalently to a large extent Black-Scholes type implied volatilities, I don't think you'd see it. It's something about the way the market imputes or prices these things that are really sort of tail type events. Okay. So let me take this kind of ideas, as this kind of speculation, sort of one step further. So I said I used sort of as a motivation for these regressions I was running. I used as a motivation the argument that wedge was arguably having to do with sort of risk aversion, and the fact that we got this kind of predictability was possibly be true because the risk aversion might be changing over time. Now that might be true, but by the same token, it might be difficult to contemplate sort of huge temporal variations in the aggregate degree of risk aversion at a quarterly frequency. You could do it, but it might be sort of a little bit of a stretch of imagination. So what we also done in that paper, and we built on in a subsequent paper that I'm also going to talk a little bit about, is we said, look, could we possibly, instead of explaining these results by risk aversion, is it possible to actually explain this as being due to true, genuine risk, time-varying risks? Okay? So the way we do that is we sort of write down a model, or we formulate a model in which volatility is actually priced in equilibrium. Now it turns out, if you want to do that by sort of a standard representative agent model, you cannot do that using sort of standard time separable utility framework. Volatility is not going to be priced in that situation. Okay. So instead what we do is we build on this model that was popularized in an influential paper by Banzhal and Jerome, where they used it as a way of thinking about sort of modeling and pricing risks in the long run, so it's sometimes referred to as a long run risk model, which is the model in which the representative agent are equipped with these time non-separable recursive Epstein Sin while Krebs Porteous, whatever you want to call these kind of preference structures. It basically says that the log of the intertemporal marginal rate of substitution of the representative agents looks like this. Okay, I've written down here what this is. Okay, but the key important thing is here that this last term, okay, which is going to be crucial for some of the things we're going to see in just a second, this last term would drop out if the coefficient of relative risk aversion was equal to the inverse of the elasticity of intertemporal substitution, which of course it would be in a standard sort of constant relative risk aversion time separable kind of utility type framework that people used a lot. So if agents have preference for early resolution of uncertainty, we get this sort of other term coming into the intertemporal marginal rate of substitution. Okay. So we take that preference structure and assume that preference structure, and then we simply postulate this particular sort of this particular process for the consumption growth rate of the representative agent. Okay. So the key thing is here, I should say that this long-run risk model that we build on, of course, has to do with sort of long-run predictability in consumption growth. We shut that down completely and just assume that consumption growth is a random walk. We could put that in there, but just to sort of make life simple, we have a consumption growth process that's completely sort of unpredictable. The important difference is here that we include in the volatility process, okay, we allow for the volatility of volatility, that's what I call QT here, we allow that to be time varying, okay? Which is key. Now there's earlier precedents of that in the literature. There's a paper by Lettau, Ludvigsen and Wachter that also have argued that the volatility of volatility is arguably time varying, and it sort of relates that to this sort of great moderation literature that have sort of happened in macroeconomics over the last 10 or so years. Okay. Anyway, if you take now that preference structure and you take that particular forcing process for the consumption growth rate, you can show that the equity premium looks like this in this model. Now, importantly, the equity premium has this extra term, okay? This volatility of volatility enters explicitly down here. It enters only if theta is not equal to 1, which is only if the intertemporal elasticity of substitution, blah, 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 is not equal to 1 over the coefficient of relative risk aversion. So now take that equity premium and sort of actually think about what does this say now for the variance risk premium that we've been talking about. It's a little bit awkward to think about the variance risk premium and all these kind of measures in this inherently discrete time model. I'm going to do the model in continuous time in just a second. But one way you can kind of think about it is you could think about sort of defining, standing at time t, what's the Q expectation of the variance of the consumption growth process from t to t plus 1, okay? And that could be defined in this way, just using the intertemporal marginal rate of substitution. And you could look at what that is. And importantly, if you look at the variance premium defined that way as the difference between the Q and the P, the objective expectations of those two variance measures within this model structure, it explicitly isolates the volatility of volatility. That's the only thing that enters there. It enters with all these coefficients, but these are just constants as functions of the model solution. So explicitly, this volatility risk premium within this model structure isolates the volatility of volatility. So taking that and going one step further, you could then ask yourself, within this particular theoretical model structure, what would the return predictability regressions I showed you actually look like? So if I take returns over different horizons, from 1 month to 2 months, 3 months, or to like a couple of years, and regress that on that variance difference, actually not the variance risk premium, but the variance difference, which effectively does look quite like that. It's a little bit more complicated expression, but it's very similar to that, okay? What would I get? And here's kind of what you get in population for sort of reasonably calibrated parameter configurations. And the key thing is that for reasonably calibrated parameter configurations that we took from other papers in the literature, there's a distinct hump shape. If you look in the bottom one, the top one is the slope coefficient itself. The bottom one is the regression, is the R square from that. There's a hump shape with sort of the maximum occurring around sort of like 3 to 4 months, which is kind of rather striking vis-a-vis the empirical evidence. Okay? So this is what the theory suggests you should get. Okay? This is what the data suggest, what you find in the data. This is the R square in the data, maximized roughly at sort of 4 to 5 months, which looks pretty much like both for the slope coefficient, the top one, and the R square, what the theory suggests it should be. So what this kind of suggests to us is that there really is, I think this sort of volatility of volatility, or this variance risk premium, is getting at some notion of economic uncertainty that is genuine and probably is a priced risk factor. Okay? Just kind of as, I guess you guys don't have that, but sort of as an anecdotal kind of whatever kind of evidence to that effect. I've shown here a plot of the VIX. Again, this would be the VIX squared minus the realized variance, okay, from 1990 all the way up to the end of 2008, okay. That difference, which normally is positive, reached a negative 180 at the end of October. which is like huge. It's totally unheard of, okay? Which is why if you actually sort of sold variance contracts, you would get killed if you did it sort of unhedged in that period. But what that suggests vis-a-vis our results is that you should see huge negative returns in the 3-4 months subsequent to the end of October. Well, we all know what happened. I mean, this is exactly what happened. That there's a huge market downturn, okay? And this sort of predates that and predicts that perfectly within this kind of this model context, okay? Now, the model I laid out to explain these empirical regressions was a model that was cast in discrete time, which is a little bit awkward for some of the reasons I talked about. It's a little bit awkward to think about these kind of integrated volatility measures and the options implied volatility measures in a discrete time context. So I would like to sort of think about taking that model and actually developing that in continuous time. Moreover, the model I laid out also has sort of fairly restrictive, not fairly, it has very restrictive dynamics for the underlying consumption growth volatility or the endowment in the process. I had basically sort of an AR1 type structure for that, which translates into the sort of volatility process of the asset that gets priced there. But of course, an AR1 structure is not the way sort of volatility or the dependencies in volatilities look. Just to show that, what I've shown here is I've shown down, I got my square up there, so this is in fact the variance. This is the VIX squared. The top line there is the autocorrelation of the VIX squared out to a lag length of 3/4 on 90 days. Okay? Oh, I guess it's more than 3/4. 3 months, 4 or 5 months, whatever. Okay? And that's a very, very slowly decaying sort of correlation pattern. It's arguably a correlation pattern that is a long memory type decay. Okay? In fact, if you were to approximate that, you would have to use a long memory type process. On the other hand, if you contrast that decay rate in the VIX with the variance risk premium given by the difference between the VIX and a reasonable expectation of the corresponding subsequently realized volatility, that's the autocorrelation structure for that, and that's a clear short memory process. Okay? So the two processes are really different. The VIX has embedded within this long dependencies in the volatility. The variance difference, or this variance risk premium as defined by the difference between these two expectations, the P and the Q expectations, are a short memory process. Okay? So I would like a model that could possibly account for these long memory dependencies. Okay? Another thing I would like to be able to explain is something that we really haven't talked a whole lot about, but another thing that's sort of a well-established empirical fact having to do with kind of return volatility asymmetries. That if you look at the relationship between negative and positive returns and subsequent volatility, for a big negative return, you see much bigger subsequent increases in the volatility than you do of a positive return of the same absolute magnitude. Okay? There's this kind of volatility asymmetry. The way that manifests itself in these particular pictures here is, what I've shown you here is I've shown you the correlation between, these are actually calculated at the 5-minute level. I've shown the correlation between 5-minute returns in the S&P 500 and 5-minute sort of VIX prices. These are the autocorrelations at the 5-minute level extrapolated out to roughly a month, or 22 days. Okay? Now the numbers are not big, but they're very statistically significant, in particular on the sort of left-hand side, which shows that if I have that lagged negative returns are associated with subsequent bigger volatilities as implied in the options market. There's a clear sort of asymmetry in that pattern. Okay? Moreover, if I look at that pattern and I look at that same pattern of the correlation of the return with the variance risk premium, I see also this asymmetry, but it's not nearly as prolonged. It sort of dies out much quicker, which of course is consistent with this fact that the variance premium is more of a short memory process. The variance itself is a long memory process. Okay? So I see these kind of distinct differences in those two pictures. Okay? By the way, I mean, there are earlier precedents of people that have looked at these kind of similar things. The nice thing here is that we have this sort of directly based high-frequency measure of the VIX and the returns, and these pictures are arguably sort of fairly clear-cut as a result of that. An earlier sort of picture of that thing, this picture, I should say, is kind of flip-flopped, I guess kind of unfortunate, relative to the previous pictures. So you should sort of mentally flip-flop that. Sort of what's left here should be right on the other one to make them comparable. But this says again that sort of a past sort of a past lagged returns are associated with, if they're negative, are associated with the subsequent bigger volatilities here as measured by absolute returns. Okay. So anyway, we'd like to explain that. So what we do in this other paper that is still in a working paper form, but you can sort of download from my website if you have any interest in that, is we take that previous model, that discrete time model, and we develop that in a continuous time framework in which we actually allow now the volatility to be completely general, okay? In particular, it allows for long memory. I'm not going to go into that, okay? But the important thing is now we can sort of sensibly and meaningfully actually define what is in effect the VIX or the variance swap rate, and this is what it looks like in that particular model. And again, importantly, within that theoretical model structure that is in essence just a continuous time version of the previous discrete time model, but with sort of various important caveats, and I think a more sensible framework to begin with, the variance risk premium again isolates this QT process, the volatility of the volatility. Which, by the way, as kind of an aside, shows that the P and the Q measure of the volatility is kind of arguably fractionally cointegrated. Because you have both the P and the Q expectations along memory, theoretically within the model, and I think also empirically, there's no question about that. But if you look at this difference, they're not, and they isolate that Q measure. Okay. So how well does this model do? Well, again, sort of reasonably calibrated, it does very well. So the solid black lines is the model implied autocorrelations for what is the VIX within the model, and the dashed lines are the 95% confidence intervals from the data. The solid bottom line is the model implied autocorrelations for the variance risk premium. The dashed lines, that nicely hugs that, is the 95% confidence intervals implied from the data. Okay? So it does a remarkably good job of that. It also explains these return volatility asymmetries, something that people really, at least in my view, haven't been able to come up with a satisfactory explanation for. Okay, there's been a lot of work that has been written on that, but I haven't seen really sort of as of yet, sort of a fully coherent equilibrium-based story for that. But here's one anyway that sort of works. You may not like it, but at least it gives sort of pictures in which these model-implied autocorrelations are nicely within the corresponding sample confidence intervals. And importantly, you get this kind of long-run, almost hyperbolic decay when you look at the correlations of the returns with the VIX, whereas for the variance premium, it's short-lived. So let me try and wrap up here. I think I should wrap up here. So what I think there's a lot of sort of exciting things. I think we're just kind of beginning to scratch the surface of this, and Torben is going to scratch another sort of part of the surface in terms of the relationship between these options and implied and realized volatilities, or P and Q measures of the volatilities. But I think there's no question that difference does in fact isolate something that is of an economic importance. Okay, whether it's truly risk aversion or whether it's sort of risk or economic uncertainty, I think is still to sort of be determined. But I think it's clear that there's a lot of useful information in that wedge, and you can refine the way you calculate that and so forth. But I think there really is a lot. Moreover, I think a lot of that wedge from what we talked about arguably kind of sits in the tails. That if you do these same calculations, I mentioned that already, looking at sort of differences between realized volatilities or expected realized volatilities and corresponding sort of narrow variance corridor swaps or effectively kind of Black-Scholes implied volatilities, you don't see nearly the same effects. Which is to say that a lot of this sort of pricing or risk aversion or whatever it might be is things that are happening in the tails. Okay, which I think is kind of what Torben, I know what Torben is going to elaborate on too. Okay, so just sort of to that effect, here's a quote from the chief economist of the IMF from a few months and a half ago that I think kind of nicely speaks to that. And he was talking about sort of what can policymakers really do to sort of quell markets and sort of help stabilize markets. And he made the point that it's really kind of the tail events that are driving things. And I think all of this stuff kind of speaks directly to that these are things that are happening in the tails. And you see that in these wedges between these different measures. So that's what I have to say. Now we can change.
So this difference between P and Q, does it vary in some sense? We've seen there's a lot of asymmetry in the Black-Scholes implied volatility. In some sense, options are more expensive on the downside than the upside. That does reflect that there is a leverage effect, at least at the equity index level. But is that where the premium is buried more than on the upside? We don't know, because the option stays asymmetric, and the actual or probability measure P also says it's asymmetric. So it's not obvious whether it's pricing it too high or not. There's time variation in these things, certainly in the level of the slope of the smirk. What about if you look across assets? I have not done as much as I would like to there, but I have something to say because I'm going to look at S&P 500, but also a couple of currencies. And I want to think a little bit about how that premium varies with the level of volatility and shifts in the volatility level, sudden changes. And all of those things are possible to look at in a very non-parametric or model-free setting by just looking at these barriers and corridors. So I make very few assumptions. And Tim made very good use of parametric assumptions. I'm going to see what we can do without that. So very briefly, how does it relate to the more general literature? We take a very different approach to this. I'm going to define something I call up and down variance. Instead of having central corridors, I'm just going to look at how much variance is there on the downside, how much variance is on the upside. That's kind of the simplest, less than ad hoc way of splitting the variance pieces. And there is a huge literature on out-of-the-money equity index options. Some people think they have an unreasonably large premium. It's very hard to come up with economic models, maybe except from Tim's, that make sense of those. So this refers back to this very pronounced skew in the equity options. But we do have this asymmetry also under the P measure. So thinking about it a little differently, people associate variance with risk. That's only true if it's perfectly symmetric. People would usually not think about variance going up when the asset prices go up as being a particularly risky outcome. People worry much more about asset pricing dropping and the variance going up at the same time. My goodness, I already lost money and there's a big chance I'll lose even more if I'm not careful. So people sometimes call that semi-variance. They want to look at the variance associated with drops in prices instead of variance associated with increases. And if there's a big asymmetry, that could make some sense. So this large negative volatility risk premium we've seen, does it differ on the downside versus the upside? And Tim really didn't directly address that. He kind of looked at the total premium, how it varied with the levels. I'm just going to directly measure, is it priced differently on the upside and the downside when these things happen? And when we go back and look in the literature, there's no direct quantitative measure that we've been able to find so far. The Black-Scholes implied volatility is in itself self-contradictory, so you can look at what they are on the downside and the upside or something like that. Look out of the money puts versus calls, and you'll get a difference, but it's really not well defined theoretically what it measures. Model-free implied, the VIX just gives you one overall measure. So now I'm going to give you a measure that says what is the expected variance on the downside versus the upside under the option pricing measures, and compare it to what we usually find under the actual measure P. Okay, so here's the formal definition. It's as easy as can be. So F0 is by theory, the accurate prediction of where we will be 1 month from now, because it's a martingale, right? So we will say, okay, our down variance is measured over this interval. That is the variance we would expect to get, not in this corridor that was centered around at the money, but we go from at the money and down. So that's variance on the downside, and then variance on the upside would be from S0 up to infinity. If you add these two together, you get from 0 to infinity, and you have the whole model-free variance. So it's just splitting the variance into two pieces, and both on the P and Q, they are additive when you consider variances. So that's what I'm writing here. The realized variance is just the variance on the downside and the variance on the upside. What you should be thinking of here is you accumulating the variation of the sample path when it's below where we started out, and where it's below, when it is accumulating variance when we are above. And when you add those two up, you get the full thing. You can do the same thing under the Q measure with the model-free. Here, I threw out the I here, but it is the MFIV from before. So you just add up the two pieces. Okay. Now, if you think about this as variance contracts, you can actually easily construct, as I've argued before, this is literally the variance swap, and here's the return you get on the variance swap in the sense that you pay this and you receive that. So this is your relative return. You subtract one, and you have from the gross return you get the net return. This would tend to be negative if you believe my data in the first part. Now you could do that on the downside. This here, you could define the variance you get if you're only accumulating things on the downside relative to what you would have to pay for it up front if you wanted such a contract. And again, that's easy. It's just the barrier integrating the right averages of the option prices. And you can do that on the upside, right? So we can literally get these returns on investing in variance in the upside versus the downside. And what I'm interested in to see if these things are different. And clearly a weighted average of those two should give you that one. But are these going to be different, and do they vary with identical different states of volatility and changes in the market? Okay? And so that's what we're going to stop it here. We're going to use model-free variance on the upside and downside, realized variance on the upside and downside, and then we're constructing returns on variance up and down contracts. And we do that also conditional on what we call the DUR. That means the down relative to up variance ratio. So what you do there is you take this guy here and you divide it by that guy there, and if there was equally much pricing of variance on the downside and the upside, you get a 1. So that variance should be centered around 1 if things were symmetric. Now you already know with the equity options you're going to get more on the downside than the upside because of the smirk. So this ratio for the S&P 500 will be larger than 1. I'm going to look at this down versus up ratio as one simple way of seeing, okay, the market is now pricing the downside more than usual or the downside less than usual, and see if that predicts anything about this premium. The source of data, and this is ongoing work with Oleg, my recent co-author on these things, who was really very good at working with these options contracts at the S&P, at the CME. But we're using the S&P 500, of course. We go all the way to 2008. For the currencies, the yen versus dollar and British pound versus dollar, we only go to 04. That is because they changed and went more to the Globex, and all the liquidity went from here to here. We also had these data, but somehow they got messed up, and it's very difficult to clean them. We either have to go back, or I was hoping to present results all the way up to 08 on these currencies, which is a very interesting period, but I'm not able to today, but we will put it on the website at some point in the future when they're available. Okay, it's just a matter of getting this data cleaned up and getting it right. So I'm going to go through these in sequence, and maybe Nikolaus could tell me when we get close to the end. We have to stop in finite time, I understand that. So the S&P 500 is most comprehensive. I'll put most emphasis on that. It complements what Tim did, but I would love to just give a couple of snapshots on what happened with the currencies. The more time I have, the more detail I'll provide, but you can also just look at the slides at home if you find it fascinating. So this is what we have, okay? And so I'll start with the S&P 500. I will sometimes use the same table, but what's indicated with yellow is the market I'm looking at. And if you want to peek ahead at the currency results, you have them there. So for the S&P 500, here I have the realized variance. Okay, so this is what actually happened. Here's what the option market's priced it at in terms of the model free. And I have both the down and the up and the total. And if you looked at variances, you would just add them up and you get 100%. So you add these symptoms and variances are not in volatilities, you just add them up and you get the right number. When you take the square roots, they're no longer additive, obviously. So keep that in mind when I get to volatilities later. So first thing to observe with the S&P 500 is that you have more up than down moves. Well, that's because the market the actual market under the P measure moves up at on average more than the risk-free rate. You're going to expect this to actually have more up states than down states, and that's what you see. So there's nothing surprising in that. That is, when we're looking at going forward 1 month, an average even up to 2008, you would get that there's been more up months or up days than down days. So that's what this measure is, about 55-45 or something like that. However, when you go and look at how much variance was realized in the downstate versus the upstate, even though this happens more of the time, it's almost double the variance on the downside than the upside. That has actually been influenced by the last few months as well, this number. So the asymmetry got even bigger between the two because there's been even more volatility on the downside than the upside. Okay, so you see the standard deviation on the downside is dramatically higher than on the upside. So you have had particularly a lot of volatility in down states when the markets have dropped. There's been subsequently a lot of volatility before the end of the month. And you see that's evident there, I guess. Now let's go to what happens under the model free. Well, now this is less than 100% higher. Here it's almost 2.5 times higher. Okay, so first of all, observe this number. The model free variance, what they priced it at was 3.12%. Annualized, here it's 2.08. Okay, so that's a whole percent. This number is 50% higher than that. That is, the market priced volatility on the downside 50% higher than it actually occurred. On the upside, the premium is much more moderate, but there is a premium, 1.32 versus 1.17. Before we included the last couple of years, these two numbers were really close to each other. It was almost like there was no premium. But the very volatile last period has giving us this difference where especially the implied variances have jumped up a lot. You add these two together, and here you have the variance risk premium defined directly in the overall averages. So this would be the VIX, so our model-free 4.44 versus the actually occurring 3.25. You see the difference here is on the order of a third or something, 30%, 33%. Okay? So 33% more priced variance than actually occurs. And this is over 20 years or something. This is a long sample period. So those are the most important facts there. Here is a plot of the S&P 500 going to the end of 2008. And we've indicated some important dates, some big events. And here you have the model-free down to up variance ratio. So Tim talked a little bit about the variance risk premium moving around. What we have here is a completely model-free indicator. My pictures are actually much less smooth than Tim's. We calculate these every day. He has either calculate monthly or smooth or something to give you nice pictures. We let the data completely talk. These are daily measures, and they look 1 month forward, but then next day the option price has been completely different. So there's not much of they're looking forward more or less in a highly overlapping period, but they're completely newly set prices. I'm not using the old prices to construct the new ones. So there's no, because volatility forecasts are serially correlated, this is serially correlated, but you can get these big shifts when something happens in the market. And if you look down here, how people price the downside much more than the upside, in some sense you get scared. You want a lot of compensation. These options on the downside are very expensive. If you want to buy that insurance that pays off when the market drops a lot, you're willing to pay a lot for them. The market is pricing that variance a lot. Well, that happened. There's a so-called mini crash in '89. Here in '91, I should remember what that was. What was that again? I forget. This is the Gulf War. So the successful launch of the Gulf War took a lot of uncertainty out of the market. So people were scared up to the Gulf War, and then within 2 days they won the damn war, basically, and so the pricing on the downside dropped dramatically. So here you have the Asian currency crisis, or Thailand going crazy, boom. Here you have LTCM and the Russian crisis and stuff like that. So you have a jump up here again, and here's September 11. You get upward jumps in this down to up pricing of volatility. And here you have an enormous up jump. It's hard to see in 2008. I'm going to give you a couple of these pictures much more finely depicted later on. So we zoom in on how it moves day by day. It's very hard to see here how abrupt these shifts are. But you can see these are very easily identifiable events. It literally by the day of where something dramatic kind of happened. Okay, and you can see daily returns tend to sometimes be larger in these days, but it doesn't have to be. So here is a picture that gives you the model-free down volatility versus what it actually was realized to be. So if you could buy a contract where you got the blue and you paid the red, you can kind of see on average that's a bad deal, right? But that's how option markets actually price volatility, and implicitly if you could trade all these options with low transaction costs, you can kind of set up, you can synthesize this actual contract, and you'll be losing the difference between the red and the blue. If you bought it, if you sold it, you'll be making that difference. On the downside variance, the upside variance, you see here the red line is down below a lot of the blues. That's because, well, we saw there was not that much of a variance risk premium on the upside, whereas on the downside you're almost always above. By the way, lots of zeros here, lots of zeros here. That's because if the prices start going up in the beginning of the month, the rest of the month, they tend to stay high, and then the downside gets zero realized variance, and vice versa. So these two blue lines would be almost perfectly negatively correlated. Not perfectly, because you can go up and down and vary around the at the money level at the beginning of the month, but they clearly will be negatively correlated. So when you add them up, you don't get any zeros in terms of realized variances, and you have this is a standard picture, basically the VIX versus realized. Okay, but here we decompose it into these two pieces that speak to the pricing of the two things. Let me just be very slow. This doesn't really matter given the time we have, but it basically shows that the upside variance is more highly correlated. The downside is so dramatic that you get lower correlation with the model-free because of the lots of big surprises, the big shocks. It's just an artifact of that. The more interesting maybe the risk premium. So let's look at the risk premium, which is really what I wanted to get a sense of on whether it varies. So we've kind of seen this number before. the difference between realized and model free. Model free was higher than realized at the tune of 1.2% annualized or something like that. But since you have a base that's a very small number, if you take one and divide by the other, we get this close to 33% or 30% that I mentioned, 31%. These are, since you divide one into the other, it doesn't matter whether it's annualized or not. Since these speak to 1 month ahead horizons, these are monthly returns of 30%, 31%. Not bad, right? So, but as Tim said, you could have been creamed, you completely smacked if you had those in 08, September or October 08, I guess, right? So there's a lot of risk in doing this. There's a big standard error. Now, what happens if you look at the down or the up version of this? Well, I guess this is all, and here's down and here's up, right? So if you look at the down contract, that actually pays 39% monthly. The other one pays 12%, the upside. So this is kind of a weighted average of the two, and you get about 31. Now, imagine that this might differ, this premium might differ, that what you realized, depending on whether the market was pricing in a lot of volatility on the downside or not. So we split the data in this low DUR and high DUR. High DUR is when the markets are pricing volatility on the downside extra high. And remarkable here, the average DUR, the average relative variance on the downside versus the upside, well, it's not 1, which would be symmetric, it's 2.3. Okay, so on the average, there's 2.3 higher times the low volatility is priced, on the high volatility is priced on the low volatility. So there's this skew is really dramatic, how the market is pricing it. Okay, if you go to the high and the low regime is just 2 and the other one's 2.6. So you average those, you get this one, of course. Now, what about the volatility risk premium, those two scenarios? Well, see here, the high, when the markets are pricing volatility really highly, Tim argued these were huge premia that was priced in. They weren't necessarily reflected. People just priced that risk very high. Well, this is certainly consistent with that. You get, instead of 39, you get 50%, whereas in the lower states, when volatility in the downside seems to be priced lower, your premium or your realized premium is also lower, okay, on these volatility contracts. So it's highly consistent with that. This is on the down state and this is on the up state, so you can add these two together. And especially under the high, when volatility is priced high on the downside, and you only buy the downside version of that risk, you get 50%. So that tells you, I think, on average, you wildly exaggerate, and there's a high premium on variance on the downside in these particular states when it's priced very highly. Okay, so that is consistent with a very high and time-varying premium that you can kind of read out of the option prices. Okay, now you can come up with a simple story that says, yes, well, that's maybe not too surprising. You would expect it to go in this direction because, you know, this variance contract on the downside is negatively correlated with the market. So when the market drops, this volatility goes up. So that is a diversification asset. You would expect it to have a low beta, and in fact, a very negative beta. And it does have a negative beta of 13. And you would, if you took just a simple CAPM as a benchmark for this, how much should that huge negative beta mean in terms of changing that expected return? Well, the expected return on the downside was 39. We can reduce that to 34 if we take that into account. But we still get an unexplained negative return of 34 relative to a CAPM pricing. We've also put in a lot of the other standard risk factors, and there's no reason why, as Tim said, this is probably a risk factor that's orthogonal to the standard risk factors, but you cannot get rid of these very negative prices. It's a different risk than the ones that are priced in standard asset pricing models. So, for the overall contract, you go from 31% to 28. The Sharpe ratios are dramatic and negative, which means you want to sell these things if you wanted to make money. At the same time, it is a very good diversification asset, and we have the CBOT arguing that you should, if you're holding equity, you should buy some of these things. You might lose money on them, but they're a huge insurance instrument against bad market moves. And they literally have plots where they don't cheat that shows you the mean variance trade-off is better if you include 5 or 10% of these variance swaps along with your long equity positions. Okay. Now, you can go further, of course. Tim said something about the tails. I was just looking up versus down. That's kind of not very sophisticated or detailed. So what we did here is okay, let's look at the lowest 25%, the next 25%, I can define my big corridors so that they encompass the whole region, but I can split it into 0 to 25, 25 to 50, 50 to 75, and 75 to 100. Again, the percentage of the returns that are in the different regions are like that. Here is what the realized variances was, so even though you can only spend 15%, down a lot relative to the risk-neutral distribution we had forecast you should be, you get more variance on the extreme downside than you do in any other quantiles, right? That's interesting. You have also more standard deviation, more wildness. Now, if you look at the model-free, how the model-free guys, how the options are pricing that, you go from 113 to 2.04. Huge premium in the tail. Okay, so there is more variance there, but it's priced even more extremely. Here you see, well, there's a little bit of a premium, 10%, 15%, maybe here's 10%, and here is, I don't know, 15, 20%. So here in this tail, you have a relatively low number, and you have a low number, but again, in the tail, the percentage premium is bigger than it is here. Okay, so indeed, Tim said something about this being pricing the tails. Well, it's very consistent with this. You get a very extreme pricing in the tails. You get more realized variance in the tails, at least on the downside than you would maybe anticipate, but it's priced even more richly on average. So this is literally now splicing it in looking at where that risk premium might be. Okay. And so here is a picture of this, where we had the model-free cumulative volatility. So you have the different pieces adding up. You start with the lowest 25%, and you can see that makes up a whole lot of the whole thing. And then you add on, you go up to the 50th percentile, the 75th, and then the 100th percentile. So the top is just the model-free implied, or the VIX, and then you get the top 75%, the bottom 75%, bottom 50, and bottom 25. And the remarkable thing is the bottom 25 is, 2/3 of the whole thing when you look at it. If you divide them by the model-free, you get measures like this. So the bottom one is almost half of all of it, right? So this is at 50%. So the lower 25% is kind of pricing half of the volatility risk premium. Now, I said I wanted to go in and look at a couple of specific events that were interesting. So this is 97 October, so that would be associated with the Asian crisis. And we had a pretty significant jump up in this down to up variance. Okay, so we got a pretty big move. Remember 2.3 or something was the average over the sample, so you're actually below average in terms of how much you were pricing the downside variance versus the upside variance. That jumped to way above normal here afterwards. And the transition was exactly around when things started going wrong in Thailand and other Asian countries. And you see the volatilities, the different levels of volatility shooting up at the same time. So down, up, and total, I guess. And so you have a fairly big return here, and then otherwise not that much happens, and things kind of slowly calm down, I guess, after this crisis erupted. But notice that you have a lot of risk pricing in terms, if you interpret it that way. Maybe the economic environment was more uncertain, maybe the premiums were higher, but certainly there's much more richly priced variance on the downside than the upside. So that was one of these big events. Let's look at what happened in 2008. So this is more current. So this is October, the month that things went really crazy, according to Tim as well. We tried to find one day where we had the biggest move. I don't know, it's kind of creeping up the whole way, right? So we were actually pretty low in the months before that, and then kind of the market slowly got up and then calmed down back again. So this would be at the end of October, November, December. Well, actually, that only goes to December, so this is October and November, okay? And there arguably you had the big jump. But here you get elevated volatility all the way through, down and up and total, in terms of how the model-free is pricing it. So you see these very big moves, and they clearly are indicative of a change in how the market. So you get the big jump in volatility, and at the same time you get a big jump in volatility, the volatility on the downside gets priced much more than the volatility on the upside. So it's all consistent, and what we basically are saying is if you want a simple model-free measure of this fear, or I shouldn't call it fear, but how risk is priced, given the uncertainty we're seeing, this might be an interesting way of looking at it. You get these very abrupt from day to day changes, and they do speak to the volatility that occurs subsequently, obviously. So trying to summarize a little bit of this little very quick sketch of what we found. There's a uniformly strong negative volatility risk premium. It's particularly large on the down variance contract. It's actually quite small on the up variance. Even more negative for the down variance contract when down variance is already expensive. So when people are pricing in very expensive premia, it is the variance risk premium seems to be even more negative. It's also more negative in the tails. We certainly saw that both on the up and down side. Extreme events induce a jump in the model-free implied variance. It especially induces a jump in this down versus up variance ratio. So that's what I have here. Selling down variance gives you a high Sharpe ratio. You cannot explain it with the usual economic risk factors. I am along the lines of Tim and saying this is a true economic risk factor that has eluded much empirical study, but is as important as the ones people tend to use when they price equity, for sure. And it turns out that we have relatively stable corridor IVs. When I plotted those scaled by the model free, you got fairly flat pictures, but you also got some significant jumps here and there. That jumps was to a high extent driven by this volatility levels. When there was a big shift or change, or big volatility is high, or there's a big change in volatility, you got changes in these relative corridors, up versus down, 25th versus 50th percentiles, and things like that. So these ways of slicing it gives you information about how things seem to be priced. How much time? Should I have 5 minutes?
5 minutes, then we still have some questions.
That sounds fine. So I'll just spend 5 minutes on the currencies. We have ongoing work as well on treasuries, and the risk premium there is a little bit more interesting than the currencies, but we don't have as much updated data, so I stuck to the currencies here. You will find smaller risk premium on the currencies now, much smaller, but still some action. So let me jump to the Japanese yen in the last 5 minutes. Here you will see something that might be slightly surprising. Since 1990 up to 2004, there's more down than up days. These are all priced so that we're looking at an up move would be an appreciation of the asset in question. So when you move up, the Japanese yen is appreciating. Now this seems to say that the Japanese yen has depreciated more than appreciated. That's actually not true over this period. So why does this occur? Because we're looking at the futures, and the futures, when you're looking at currency futures, price in the interest rate differential between the two currencies. And the yen has throughout had low interest rates relative to the US dollar, which means the yen should have appreciated by the interest rate differential. And in fact, it did appreciate, but not quite as much, which means on average, the carry trade would have made money. You would have sold the yen and bought the dollar, and because of the interest rate differential, the yen appreciation would not have offset that. So that's what the futures give you a clean cut on. They say that you would actually have made a little bit more money on going that way, taking the interest rate adjustment into account, and the futures do that automatically. Okay, so since there's an expected appreciation of one currency versus the other, when there are interest rate differentials, that shows up in the futures relative to the spot. And that's clean for that. So that's why these numbers are flip-flop relative to what you would expect. And the same thing is going to happen with the British pound. It actually, the carry trade would have made money. The British pound was a high interest rate currency. Even though it depreciated over this period, it didn't depreciate as much as the interest rate differential should have told us it would have. Okay, so that's questions out of the issue. So there's about equally much variance on the upside and downside for the yen. You would expect these things to be more symmetric. It's not bad economic state is not necessarily associated with the yen going up or down. However, it's fun to see that there's much more skewness and kurtosis on the upside. So there's been some dramatic appreciations of the yen, sudden dramatic appreciations of the yen, which is actually something people do carry trade know about. Suddenly the yen appreciates and people get scared and they sell off the yen and it appreciates even more. So you have this jerkiness on the upside, and that actually implies that even though there was more occasions in which we were down than up, there was actually a little bit more up variance and down variance. Now, to make it short, let's just look at what the premium were. In the down states, about 0.10, and the up state 0.05. Okay? So this might have been more than people expected, so the premium became a little less. That's my interpretation of it, at least. There were these very dramatic appreciations of the yen occasionally that made that premium less. But you will see there's a premium on both sides, and it's not dramatically asymmetric. So that goes somewhat along the intuition we got the S&P 500, where we expect it to be skewed. Here we wouldn't expect a dramatic skew, and it's not dramatic. Now that's a little bit boring. Let's not look too much at these correlation numbers given the time. What I do want to look at is this down to up variance ratio. Now down variance would indicate times where the market was pricing variance for the yen to depreciate highly. And when we go down on the graph, that's when the market is pricing variance on the upside, when the yen appreciates highly. So it's more risk on the upside versus the downside. So movements in this tells you where the markets are worrying about the variance happening and the risk happening in terms of appreciations and depreciations. And we just isolated a couple of incidents. Here is a big move. It's up on that particular day. The market had gotten very far down, and it jumps up. Well, again, this is around the Asian crisis in 97. And then we looked at the September 9/11, so the terrorist attacks in the US, and just to see what happened on those particular days. Here is not that much of a move, but there is a move. And here there's a pretty big move. But these other events can also be associated with things that are well known. So you can decompose these things the same way, given that I don't have much time. I'm not going to talk too much about it. But you can see overall the risk premium here. There's this once in a generation. There's a paper that's called Once in a Generation Yen Volatility in 98. That shows up here by surprising. And then the Model 3 tries to catch up afterwards. So you get compensated here. But you actually did lose a lot of money here if you were selling variance swaps. Usually you would make money because the red line is a little bit above the blue, but the variance risk premium is not nearly the same as it is for S&P 500. And you can look at the up and the downside separately. So we do that. Here the table, and you can go in and look at the different scenarios here. The variance risk premium, if you sold variance on the variance contract, you'll get about 6.7%. So there is a negative variance risk premium on the yen as well. There's a smile in the implied volatility, but it's not nearly as dramatic. If you go to this V1 to V4, so the first 25%, the last 25%, you would see that there is a very nice pricing of volatility risk in the tails here. This upper tail, very little because people got surprised by these big appreciations, I would argue, in the yen. But in the tail, you can find evidence that there might be a big premium, whereas in the middle, these are essentially zero, right? 98 versus 39 versus 38, and here 34, 38. These in the intermediate range is basically fairly priced on average. So that's interesting. It again leads you towards the tails. And here are the cumulative variances. And I think I want to look, just because I have a few minutes left, let's look at what actually happened in this 97 evidence. Here you actually had a big jump in down to up variance ratio, okay? So that means people got worried about the yen depreciating. That's because all the other Asian currencies depreciated. If that continued and the whole region was melting down, gee, there was a downside risk on the yen. But actually not much happened in terms of what the yen returns were. That was a little bit more negative than positive, but it wasn't that dramatic. And but you could clearly see definitely where the market was pricing the risk, was on the downside because this whole region was under attack. What happened in 9/11 was a very different scenario. It was a little bit drop here. If you want to call it a change, it's a drop. That means there's a risk that the yen will appreciate. There's more variance on the upside. Well, Japan was pretty far away from the US. The attack was the US. Next people expected to be in Europe if there's going to be more attacks. So that makes some sense. But by and large, the yen-dollar exchange rate was not affected at all. And all you got was actually a jump in the overall level of volatility, but equally much on the down and upside, almost equally much. So that makes sense. You can see how the market is differentiating very much in these two pretty dramatic events in terms of how they price the variance risk. The British pound is a more stable currency, not as volatile as the yen. The downside variance, well, let me not discuss this very much. I can go and look at a couple of events. The premium is a little bit higher, 10%. It's positive both on the downside and the upside if you look through. And yeah, here the pricing is clearly in the tail, 21 versus 27, 19 versus 23, whereas in the middle you are more equal. So more average volatility pricing in the tails, consistent with all the other stories. And these are very flat. If anything, you can see a slope that's a little downward, which means people are getting more worried about, see, we start above the line and we're going down to the line. People are getting a little more worried about risk on the upside of the pound, and that's because the pound was very strong in the in the beginning of the 2000s, and people were actually worried about upside volatility. Let's just look at a couple of events. So what is this? This is Black Wednesday. Okay, that was when the pound tumbled out of the euro arrangements of the EMU. So we had a sharp depreciation, and you see down to up variance. It's been going up. The crises were taking place. This is above average, and then you got to jump up again when on the day, and then it stayed really high. And here you see the volatility itself jumping up a lot. So indeed, it does show up. You are way above average in terms of variance, depreciation variance risk for the British pound. And you had more depreciation after that, and this is a big drop that you saw in the day. Now, what happened at September 11, and that's the first day trading after that in the markets? Almost nothing. Down to up variance doesn't change. Britain seemed to be as exposed as the US, but you'd have pretty big jumps in the model-free variance right around that period there. So again, 9/11 was not much of a currency event, seemingly. You'll see the variances jumping up because of the uncertainty in the economic environment, but not much in the differential pricing, whereas there clearly was something going on over here. And so just to summarize, what I didn't have much time to talk about is what happened on the currencies. You had negative volatility risk premium as well. Yen is more volatile than the pound. The implied volatility patterns is pretty close to a smile for the yen action. There's a slight downward tilt for the pound on average. There's some particular patterns, and I haven't talked about them, so let me not summarize them, but basically the actual realized volatility premium was higher, turned out to be higher for the pound than the yen. I think that's because there was a couple of surprises for the yen. What I really would like to do is update this desperately to 2008, because the carry trade has completely reversed. The yen has appreciated and the pound depreciated, and I think you'll see the volatility premiums shifting dramatically. That's the data we're trying to get, but I didn't get in time for presentation here, which I would have wanted to. This is really only scratching the surface of what you can use all these corridors to in terms of extracting information from the option prices. We studied centered CIVs and specific locations, the risk premium up or down, but you could check for whether they are constant. Obviously, we don't think they're constant, but you can do a variety of specification tests on what that volatility risk premium might look like, how it responds to various events. I kind of started that kind of anecdotally. What pieces are correlated with macro risks? Tim, I already tried to put some color on that. How are jumps related to this? So we have techniques to extracting jumps from high frequency data. Well, does that also correspond to jumps in these option implied measures? And how is that priced? It tells us more about how this negative asymmetry appears, perhaps both under the P and the Q measure when we combine these things. And most importantly, perhaps, is both look beyond that 1 month maturity, look at the term structure of these things and across markets to get a better understanding of how this variance risk premium is priced and perceived across different macro markets. So that's a research agenda for lots of people going forward if they want to pick it up. And I will leave it there.
Thank you.
First of all, I will have a question from the last talk, but it's good that I waited because now I can put it under one framework. Essentially, the framework is dimensionality. You imagine an investor looking at in the future. He looks into possible states of nature. That means he looks at different K strike prices. He looks at different tau. So that's why you model an IV surface, right? But then, then in the first part of your talk, there was this modeling of IV surfaces, and then all of a sudden you were jumping into only one-dimensional ATM. There's a fixed tower that was 1 month and 21 days. So the dimensionality question. So why is one not interested in modeling the whole surface, the dynamic of the whole surface, right? You modeled one number that you extracted from the surface in its dynamic. And the same applies to Tim. This question, there was this, right at the end of your talk, is that you cite this where does the difference between Q come from? The right way to model is that by the pricing model, that means the limiting derivative of Q relative to P. And this at different towers again gives you a surface. It gives you the surface of empirical pricing models, and you can study this dynamic. And that means you get a much more general picture of risk premium and risk aversion of volatility. Again, you model it into, you call it volatility. It is a symmetric measure of variation around volatility. So you don't get higher dimensional variations, like, for example, the Bollerslev dynamics, if I'm right.
Okay, let me just say a couple of things, and then Tim can probably supplement me. So you can give Tim that one, since I still have my amplification. First of all, we do look across the strikes, at least when I do my corridors, right? So I look up and down, I look at the tails one way or another. So I do splice it a little bit across states of nature and argue that the premium looked different. So that was part of the game. However, you were absolutely right that I fixed 1 month as being pivotal across everything I said today. We actually have looked at something from 3 weeks and out to 6 months, and it gets constrained by how liquid the options trading is, so whether you can extract reliable measures. Out to 6 months, we're fairly comfortable we can do something. There's interesting things, but more limited than you might think. It's almost as if there's very little thought going into volatility forecast out on the further dimensions. So we will explore this going forward, but in terms of making some pointed, interesting insights, I'm not ready to say that there's a lot of extra information going out to 6 months. Now, if I had something that was out 2 years or 5 years, that might change. And there occasionally are things between 3 weeks and 6 months that look striking, but the quality deteriorates as we go out to 6 months. So the statistical ability to discriminate and say this looks really significantly different gets harder. And then on top of that, a lot of the literature we refer to somehow had chosen the VIX and 1 month as a benchmark. There's absolutely no reason to let us be constrained by that. So I've argued we should look at different assets across strikes in snaps, and for that matter across different maturities. And I agree. So you are right. We've not gotten there yet, and I think in terms of the particular way I did it, it's a little bit limited what we should hope to get, because the options information isn't quite as rich as you would like.
The new information in the maturity dimension of this thing. What Tom was doing, he wasn't actually looking across different strikes. That's what you're doing here. That's really what's going on. But the other end, take the flip side of that argument and say, look, why looking for a different strike? If you really believe there's an economic underlying fundamental risk premium that this is getting at, there's only one measure. That's the risk neutral minus the P. And that's it, that's one measure. Now where it's coming from is interesting from sort of like understanding potential and so forth, but there's one risk measure. From that perspective, if you sort of believe in kind of the stylized model that I go down. So from that perspective, then you don't need to do that. If this is the measure that is priced in the market. The market prices that, by the way, it sort of averages across everything against a single risk measure. Potentially.
Have you looked much at the correlation across, so back to the question of whether or not this is driven by increased uncertainty in a particular market, which could certainly correlate with a systematic factor, or a change in risk aversion. If it's a change in risk, it seems like we should be able to tease that out by the risk aversion driving it in a different way across markets.
That must be Tim's.
I don't have anything to say that. There's some work that people try to do that, look at cross-section implications and things like that. I think there's a lot to be done along that dimension. I mean, whether it is risk or risk aversion that's changing. I don't have anything to say about it. It's still new stuff. I think that's interesting.
Truly interesting.
Cross-section, this is the way to go to really understand that.